with a minibar. Have you been to the minibar yet?
I have not been to the minibar, no.
Or does this hotel not have a minibar?
I do not believe it does have a minibar.
Oh.
I haven't seen one. But, a lot of things are closed because of COVID. Like the fitness center is closed because of COVID. The breakfast that they normally serve is closed because of COVID. Housekeeping not happening because of COVID.
Well, that's horrible. What do you do without your turn down and your little piece of chocolate every day, Paula?
Wow, I've never stayed. No, you know what? I've once stayed in a place fancy enough to have a piece of chocolate. Once. That was, I believe it was 2014, 2015. Yeah.
Paula's like, I don't think they have that at the Super 8. I have no idea what you're talking about.
Close. I'm Holiday Inn. Holiday Inn Express.
Perfect. You stayed at Holiday Inn once. That makes you a big deal. Do you know that commercial?
No.
You didn't see those commercials? No.
No.
There was this whole line of commercials. I love, by the way, everybody, if you're new to this, I love explaining pop culture references to Paula Pant. It is super fun. But there was this whole line of commercials, Paula, that were these people talking back and forth. And one person says, "Hey, are you so-and-so?" And the guy says, "No, but I stayed at a Holiday Inn once." It's like, oh, yeah. That must be a big deal.
I see. Like it's the equivalent to being a celebrity.
Yes, absolutely. Hey, Kevin.
Hi, Kevin.
Glad you could join us. So anyway, Paula and I are going to make 2 episodes. Mm-hmm. You can see the descriptions in the descriptions of this. I don't hate it when you use the word early in the sentence. And you got to go back to it. Not good. We're going to have 2 episodes. First one about private equity and 401k plans. Lots of fun there. And I'm sure Paula and I are going to duke it out, which is going to be the funnest part of that. And then the second one about money markets, where I'm predicting ahead of time. I think we'll disagree on the first one. I think we'll agree on the second one. So is
it a prediction if you yourself can influence the outcome?
That's probably true. Like if you say the thing that I want to say and I find myself in a spot where I have to disagree, that's going to be difficult. Hey, Craig, how are you? You're right. Words are hard. You have no idea how.
Hello, Craig.
I just hit a wall like an hour ago, so I'm happy to be with you guys and Paula right now to keep me moving. I got up early and started today. All right, Paula, you ready to make a podcast?
No, but let's do it anyway.
What the heck? Let me see. Let me get my stuff ready. All right, guys. Please comment on this. What do you think about hedge funds and private equity stuff inside 401k plans? Please comment. You'll be part of the show. All right, here we go. This is going to be for Thursday. The 27th. Oh boy.
Thursday.
It's got to get better quick. Here we go. August 27th. Well, you've heard about hedge fund investments and the promise of big money, but here's a question. Should private equity be available in your 401k plan? We'll ask that question to today's thought leader, Paula Pant from AffordAnything, and our audience hanging out with us live on social media on today's Money with Friends. Welcome to the Money with Friends podcast, coming to you live from my mom's half-finished basement in Stowe, Vermont. I'm Joe Saul-Sehy.
And I'm Paula Pant from AffordAnything.
Coming to you from...
I am coming to you from a Holiday Inn Express, which Joe has just informed me makes me a somebody.
It absolutely does. Do you know who I am? I stayed at a Holiday Inn Express. This is the podcast where we cover recent stories ripped from the financial press. Today, we're going to tackle one from the Wall Street Journal. Not only do we read them like some podcasts do, but we dive into how they affect your wallet and what you can do to invest, save, or pay down debt more effectively. And if that's not enough, we're also going to share a big idea at the end of today's show you can take with you to be better with money the rest of your day, and all in less than 20 minutes. Today's show is brought to you by NordPass. We lock passwords. You hold the key with NordPass. Store your passwords in the cloud, access them on the desktop, mobile, or your favorite browser, all encrypted on your device for your eyes only. Get 60% off and a 30-day money-back guarantee if you use our link, nordpass.com/MWF. That's nordpass.com/MWF. Paula Pant joins us today. I'm so glad you're back, Paula. How have you been?
I'm excellent. How are you doing?
Well, I'm great. However, I think we're about to have some fun as my phone rings. We're about to, nothing better than live TV. We're about to have some fun talking about 401ks and these new investments in it. Well, you know what? I'm not even going to foreshadow it. Let's just get into it. Let's see which one of our friends is going to help us start today's show. All right, this piece comes to us from the Wall Street Journal. It's written by Ann Turgeson, The Mixed Case for Private Equity in Retirement Plans. Paula, you want to do the honors?
Absolutely. With the help of regulators and lawmakers, 401k plans are trying to become more like the old-fashioned pension plans they replaced. The latest example involves private equity, an illiquid investment that is a staple in pensions and now wants to be in your 401k. While the addition of shares of privately held companies may boost 401k investors' returns, there are reasons for concern, including high fees and a lack of transparency. Earlier this month, the Labor Department issued guidance confirming that 401k plans can offer private equity in a diversified fund, such as a target date fund. These portfolios shift from stocks to bonds as people age. Because they serve as default investments in many 401k plans that automatically enroll workers, they receive more than half of employees' contributions.
For private equity firms, some of which have been trying for a decade to break into the $7.9 trillion market for workplace retirement plans, this is a victory. 401k plans have become a huge pool of long-term money, said Fred Reich, an attorney who specializes in employee benefits. He said other liquid investments, including hedge funds, may also use the guidance to market themselves as additions to target date funds. Labor Department's move follows a 2019 law that encourages 401k plans to replicate other features of old-fashioned pensions by offering annuities, insurance contracts that turn savings into a monthly income for life. We'll have the rest of this, by the way, on our website, moneywithfriendspodcast.com. But Paula, what's your take here? Private equity inside of your 401k plan. Is this a good idea or a bad one?
Well, I mean, time will tell, but my initial impression is that this is more a victory for the people who run and own private equity firms than it is for the average 401k individual investor. And those high fees, that lack of transparency that they mentioned at the beginning of the article, spot on.
You know, somebody named Ray Dalio runs one of those big funds. So there are people who do really, really well with those funds. However, I got to say, I don't think the average person with a 401k was sitting here thinking, you know what I've been missing out on? You know what I wish I have that I don't have is private equity inside of my 401k. That's the thing that I really think I need. I don't understand why investors need this.
Right, exactly. Well, it seems as though it's going to increase the volatility in a portfolio, increase the volatility in the underlying funds, such as target date funds that it's in. And as we've seen from individual investor behavior, when volatility increases, a lot of people do some dumb stuff, particularly if it's their first pullback, their first recession, their first market crash. A lot of people lock in paper losses. And so my concern is adding some volatility to a 401k is just not comparable to adding those same types of underlying assets to a pension plan, which is managed by people who are less emotionally connected to the outcome of said investment.
Well, let's talk about pension plans for a second because of the fact that there was that feature they talked about at the end of that piece, 2019, where they added annuities, the ability to get an annuity inside a 401k. What do you think about that move?
Again, with annuities, I mean, it's one thing for an individual or a couple to go out and purchase a simple income annuity for themselves. I think it's another thing entirely for funds to start layering in annuities into the underlying, into the mix of assets that a given fund holds. It seems as though it would increase the fees without necessarily offering a good reason as to why. It's not, I know there's more to life than fees, but it just doesn't seem necessary.
To have the annuity inside of it.
Correct.
See, this is where I thought you and I would differ, because I actually liked the fact, and OG and I went back and forth on Stacking Benjamins about this too, by the way. So, and we have plenty of listeners that didn't like my take on this, but I think that annuities do something different, Paula, when you strip them down. If you're somebody that just wants a pension that you can't outlive, and those have gone away, now you have this ability to build your own if you want to. So if you strip away all the baloney around annuities and just use it for that pension feature, I thought it added something that you couldn't get in a 401k, which is a guarantee that this money will last forever. Well, you could, I guess, put it all in the guaranteed income fund, right? And watch it never grow. But then you still don't have the guarantee that you can't outlive it. With an annuity, you actually get that guarantee. I feel way differently about this one, which is weird because now I feel like I'm contradicting myself. Like I'm like, hey, annuities are fine in it, but hedge funds, private equity funds, no way, leave that stuff out.
And what do you see as the main distinction between the two?
I think the distinction is that annuities offer everyday investors who aren't sophisticated an option that really you don't have to be sophisticated to get. I get X amount of money per month that I can't outlive. Can't more than that, but I can't outlive it. There are people actually in my immediate family who are living on annuities, and it's mostly because of the fact that the people that gifted them this money knew that they couldn't trust them with a whole big sum of money, so they give them a little bit of money every month, and they can't outlive it. And you know what? Seeing that firsthand, Paula, is a beautiful thing for some people. It's an absolutely beautiful thing. I don't see anything beautiful here except the promise of maybe more money. But to your point, like you said earlier, not transparent, crap loads of fees, and all I get is I feel like it's much more the roulette wheel that I pull with a hedge fund.
So what you're saying essentially is that while both private equity and annuities will increase the fees in the assets that you hold, annuities increase the fees with a trade-off of more certainty. And in that regard, they're sort of a more conservative way to move, whereas private equity is it increases the fees, but in the direction of more volatility. And in that regard, it's a more aggressive way to move.
Thank you. Do you mind coming on all the shows and being my interpreter? Fleshing it out for me. But let me say this though. But then I say that one's okay and the other one's not okay. So then I pull back off that. And my next thought, Paula, then is, who am I to decide, right? I mean, who am I to decide this is right or this is wrong? What if they were all allowed? They were all allowed and people can decide for themselves? Or are we getting too far down the rabbit hole there where then we allow some really sketchy stuff in and people get taken advantage of all the time? At what point is the government playing too much Big Brother?
I'm just something like a target date fund. You know, people who go into target date funds often are people who don't want to make those decisions. They don't want to necessarily make asset allocation decisions for themselves and then have to rebalance every year. So they're drawn to a target date fund precisely because they want somebody else to decide, somebody like you, a former financial planner. You know, that they're looking for the experts to make the decisions for them. And essentially they're saying, this is my pool of money. This is my timeline to withdrawal. And you manage it. You manage the risk and reward in such a way that it is that it adheres to that timeline.
Yeah. Yeah. So does that mean that because there are some experts between you and the money, in other words, you're not picking private equity yourself, there's a target date fund person doing it, does that mean that might kind of make it okay?
I mean, and then we get really close to, we're getting pretty close to like actively managed funds, you know?
Which those are in 401ks. You already have actively managed funds in 401ks.
Yeah, that's true. That's true. You do have actively managed funds in 401ks. But I suppose my hesitation is that I would suspect that the average individual investor does not fully understand that the risk-reward profile of private equity is inherently different than the risk-reward profile of equities, like publicly traded equities. And given that lack of understanding, I question essentially how much complexity we should add into the portfolio if the goal is that you would want an individual investor to be able to make more informed decisions. And so by keeping it as simple as it needs to be, or conversely, making it only as complex as it needs to be in order to meet the goal and no more complex than that, I wonder if we could leave out private equity and still keep the necessary amount of complexity that allows those individual investors to meet that goal while also understanding what they hold.
Yeah, it's a really interesting dilemma. And of course, the people hanging out with us on Facebook, on YouTube, they have some opinions also. We've got, let's go back here to a point Kevin had hanging out with us on our YouTube channel. It's youtube.com/money with friends. Says, do you think private equity could be limited to the plans of executives? It doesn't make a lot of sense for the most part.
Well, I mean, then you get into framing access to private equity as a reward. It kind of plays into the whole, like, this is why the little guy can't get ahead.
Or it's more like a accredited investor type thing, though. Maybe not executive. Yeah, but you're right. I mean, I could have a great title. There's that joke that people that don't have much money give the people that work for them these great titles so that they don't worry about getting, being underpaid. Hey, I'll just give them a phenomenal title and pay them $20 and hopefully they'll really like that. So what's executive mean too?
Right. Yeah, it just seems like it seems like too much gaming the system and sort of stratifying who gets what. Yeah, and I mean, what happens if an executive quits and does a rollover in their 401k and then takes a step down on the career ladder and becomes a non-executive at the company that they switch to, or takes a year off in between jobs? It just seems like that would only add to the question marks.
Yeah, Brian hanging out with us says investments are investments, insurance is insurance. Why don't you create a whole bunch of dividend stocks in a side account and save on the fees? Brian, for somebody who's kind of investment savvy, that's fine. I think he's talking about the anti-annuity here. Don't have an annuity, create an income stream for yourself. I'll tell you what happened when I was a financial planner was that when that portfolio goes down 30% and somebody isn't savvy enough to understand the need to ride that out. And by the way, you and I might not think that you have to be that savvy to get there, but I'll tell you, there are plenty of people that just can't get there and will blow up their strategy all day long. An annuity made them feel way, way, way better because they knew they could. They knew that even though it was somebody who was getting a big fee for their service, that they could not outlive it. They couldn't second guess it. They didn't have to deal with watching the market all day. They just got a check in the mail one day a month and they were able to live off that. I think it's a little different thing, Paula.
Right. Well, and again, I think there's a difference between an individual going out and buying a simple income annuity for themselves versus having annuities baked, as a part of your portfolio.
Yeah.
Yeah.
It's interesting that we now have this, and it feels like it's been a slippery slope lately the last couple of years where we had annuities first. Now we have private equity. Next, we'll be able to bet on horse racing inside our 401k.
Crypto.
That'd be great, wouldn't it? I got all my Bitcoin in my 401k.
Oh, jeez.
In just a second, Paula and I are going to have our takeaway from today's podcast. But before we get there, I want to say thanks to everybody who's used our link when they visited NordPass. NordPass is the password manager that I use. They lock the password. You hold the keys. You'll get 20% off and a 30-day money-back guarantee if you use our link. What I like, by the way, about NordPass is not only do I not know any of my passwords, NordPass holds them all. If somebody does get a hold of one of my passwords, they don't get a hold of everything. I used to have a fantastic password. I used it for everything, thought it was really cool. And then I realized, you know what? Somebody gets a hold of that one, they get a hold of my whole financial life. Not the case with NordPass. Something I really like is that all of my passwords are in one place. So if something happens to me, my beneficiaries, or in my case, Cheryl, knows exactly what all the passwords are to get into the stuff. Or if something happens to her, I know all the passwords. Makes it super easy. Check it out and you'll get 60% off and a free 30-day trial. NordPass.com/MWF. Paula, what's our big takeaway here?
Ooh, I would say our takeaway is that, like it or not, regardless of what you think about it, the reality is that the assets that could be offered by your 401k are about to become more complex. And so for those of you who are savvy enough to be listening to this, it is a reminder to pay close attention to what's in your 401k, to pay close attention if you're in a target date fund or any other types of funds, to what the underlying holdings in those funds are and to know what you're invested in.
Yeah, I don't have much to add to that for my takeaway. It was going to be the same thing. I'm not waiting on the government to decide what I can do and what I can't do. I want to take whatever's available, no matter what these third parties decide I can do, and make sure that I drill down. I know what they are. You know how many people, Paula, are about to have private equities inside of their target date fund and they'll have no idea?
Exactly. And that's the part that weirds me out about this whole thing.
Yeah, me too. So use sites like Morningstar to drill down and take a look and see where your money is. Paula, I heard there's this incredible podcast out there called AffordAnything. Is that true?
It is this fantastic podcast. Available anywhere where you can find podcasts. Go to your favorite podcast playing app, whether it's Apple Podcasts, Spotify, Pandora, Stitcher, Overcast. Go to your favorite podcast playing app and type in AffordAnything and hit subscribe or follow. And what's super cool is that approximately 1 out of every 4-ish episodes, this guy by the name of Joe Saul-Sehy joins me on the podcast.
That guy?
That guy. We let him.
Oh, man.
We let him come on the podcast, and we answer questions that come from the community.
And those are some fun episodes. You want to hear Paula and I duke it out? We've duked it out a few times there.
Totally.
All right. That's where you can find Paula. You can, as soon as you finish this, just go subscribe to AffordAnything. Good news, though. Paula's going to be back tomorrow for more Money with Friends. We'll see you back here tomorrow. Bye-bye. 18. Nice job, guys. Lots of great chatter. Lots of great stuff. You actually can. Yes, not in your 401k, but you can in your IRA. Yeah.
Oh, in a self-directed IRA?
Yes. Yeah.
Ah.
That's funny, Brian. It's like, who? Joe, who's going to be on your show? Yeah, isn't that wild? That's what drives me crazy, Joe, is that they're putting it in the target date fund, or to use Paula's phrase, that's what weirds me out. That's a good phrase. By the way, so we were at Calvin Coolidge's homestead yesterday touring. It was fascinating. For people like Paula, that's a president back in the 1920s.
I do know that. I don't know pop culture, but I do know history. He went by the nickname Silent Cal.
Yes. And he there was in his museum, there were a bunch of phrases we use today that come from the 1920s. And I wish I had it in front of me because it was fascinating. Like some of these phrases that we use today that came directly from there. All the changes in culture back then. I don't know what brought that up. Oh, when you said weirds me out.
Oh, yes. Weirds me out. Yeah.
Yes.
I take it you can't think offhand of an example of some phrase from the 1920s.
I totally wish I could, but I can't think of one. And they're on my, I take most of my pictures of my phone, but when we go in a place like that, I take pictures with my camera. So I have it. I would just have to go out to my car and look at the little screen. And so, yes, yeah. I will know in a little bit. She knows Calvin Coolidge, but not Calvin and Hobbes.
There is a great meme. Speaking of like fantastic memes of 2020, there's a great meme that says, "You want to feel old? This is Calvin and Hobbes now." And it's a picture of Tiger King hugging one of his tigers.
That would be about the age. That's pretty scary. All right. We ready to make another one, Paula?
Let's do it.
Okay. Paula and I get to hang out a lot tonight. We're making a Stacking Benjamin almost as soon as this is over.
I'm also today releasing that episode that you and I recorded last week. So
Oh,
that
cool.
episode comes out. I think it came out as we were recording this in the last half hour, as we
You're
were
welcome.
recording that last Money with Friends.
And all of a sudden, the people hanging out with us live goes down as everybody goes and gets that far better episode. All right, let's do this. This is going to be for Friday, the, oh boy, is that the 29th, 25, 26, 27, 28th? Thank you. Without my fingers, I would be in big trouble. Here we go. Money funds are paying next to, or well, nothing. What's that mean for the system overall? We'll tackle that and more with Paula Pant from AffordAnything on today's Money with Friends. Welcome back to the Money with Friends podcast, coming to you live from my mom's half-finished basement one more time in Stowe, Vermont. I'm Joe Salsi. Hi.
And I am Paula Pant.
Coming to you from
a Holiday Inn Express.
This is the podcast where we cover recent stories ripped from the financial press. By the way, Holiday Inn Express, if you want to sponsor Paula, just send us a link. Today, we're going to tackle a piece from the Wall Street Journal. Not only do we read them like some podcasts, but we'll dive into how they affect your wallet and what you can do to invest, save, and pay down debt more effectively. If that's not enough, we'll share a big idea at the end of the show you can take with you to be better with money the rest of your day, all in less than 20 minutes. Today's show is brought to you by Acre Trader. I'm from West Michigan, which is farm country. I get farming, and I don't think that farming is something most of us should do, but buying farmland, I think, is a fantastic opportunity for the right person. How do you know if you are? Well, head to acretrader.com/MWF, watch the explainer video, and then do your due diligence. We'll talk more about them later in the show, but it's acretrader.com/MWF. Paula Pant back here for her swan song. Sadly, as we're wrapping up this season, Paula, this is the last time we'll be together here.
Wow, that is the nicest way anyone has ever said, I'm kicking you out.
Get off my lawn, Paula.
Yeah.
We're going to do it with just the thing that Paula has been dreaming about all the time. By the way, just a look behind the curtain. Paula probably every third day says, can we talk about money market funds? I really, really wish that we could talk about money markets. That'd be great. And I'm like, Paula, back off, okay? And finally on this episode, we're going to talk money market funds. So let's see which one of our friends can help us kick this off. All right, that last statement by me may or may not have been true. Paula probably didn't say that, but we're going to do it anyway. Don Lim wrote this piece in the Wall Street Journal. The headline is Money Funds Waive Charges to Keep Yields from Falling Below Zero. Many investment firms are waiving their charges on money funds to keep the yields that investors earn from dropping below zero. Money management giant BlackRock Inc. is waiving costs typically borne by customers for certain money market funds to prop up investor yields, says people familiar with the matter. Fidelity Investments, Federated Hermes Inc., and JP Morgan Asset Management are also ceding some fees to stave off negative yields. The moves are the latest sign of how a roughly $5 trillion piece of the financial system is bracing for new pressure as interest rates plummet. Fee waivers will hit the revenues of firms that should shoulder the cost. Paula?
All types of investors, from individuals and corporations to pensions and hedge funds, use money market funds to park cash safely while earning some pocket change. If an investor deposits money with a brokerage, for example, that money can sit in a money market fund until the investor decides what to buy. But investment firms don't just hold those funds. They buy highly rated debt with the money, passing on some of the returns to investors. As this industry has grown, money funds have become a critical source of short-term funding for the U.S. government, companies, and municipalities. Today, the income offered by those funds is evaporating as interest rates plummet. The Federal Reserve cut its short-term benchmark rate to between 0 and 0.25% to calm markets in March, and it pledged to keep rates near zero for the near future. 3-month Treasury yields were 0.0928%, specifically, as of August 21st, down from 1.546% at the end of last year.
I feel like the Fed is doing the, are you familiar with the limbo, Paula?
Oh, yeah. Where you go under You know
Yes.
what? There's another meme, actually. So I guess I know my memes pretty well. There is a meme of, it's not the limbo. It's somebody doing the splits.
Oh,
And this was from March when the stock market was dropping. And it says like, nobody, blank, absolutely nobody, blank. And then it shows this guy doing the splits going, and the limbo was what reminded me of it. And his statement is, I can go lower. And he's supposed to represent the stock market.
well, the Fed is playing that game. I mean, you look at 1.5% and you think, man, that's low. No. The Fed goes, no, we can go a lot lower. It's crazy. You know, I think, and the reason I wanted to bring this up is because I think a lot of people, Paula, don't realize that money market funds, if they're not insured, if you just have it inside a brokerage account at one of the big firms, they can lose money. They try not to lose money. And there's only one time I remember them losing money, which was the 2007, 2008 crisis. They lost some money. But generally, people don't know that. And they have no idea that there's some risk in this investment class at all.
Right, absolutely. Because it's easy to think of a money market account as an alternative to a savings account. You know, it's because your money feels like cash when it's in there. And so it's easy to make the assumption that you have all of the same protections that you would have in an FDIC insured bank account. But the reality is that you don't.
When it comes to cash, then, do you worry about having insurance on your money?
I mean, the thought has occurred to me, like if within my business, if we have like a big infusion of cash for a minute, but before it all gets paid out, and that balance goes above what the FDIC would insure, then the thought has occurred to me, like, well, if the banking system were to collapse, I would lose the difference between the amount that is insured and the rest of it. But honestly, that has not been enough money and not been, by the time we have to go pay all of the operating expenses for the business.
Yeah.
I mean, we're not talking about something I'm hanging on to for years.
Right. What do you think? Let's pivot here. Let's talk about these firms waiving all these costs. Are they waiving the cost altruistically? They waiving the cost to make sure they don't break the zero, so that the money market doesn't go below zero because of competition? Why do you think they're waiving the cost?
I mean, I would say it's good marketing and good customer service. If they're waiving these fees and taking the hit to their own revenues so that it doesn't drop below zero, so that people who have put money in these money market funds don't lose their money. I mean, imagine the alternative. Imagine if people actually lost money in money market accounts. That is really bad marketing and really bad PR. And that stain is going to stay on the brand name of a company for years and years and years to come, even when the Fed is throwing out very different numbers than it is today.
I'm laughing because the conversation that people are having as we do this live on social media isn't about money markets, which we're all worried about. It's about the limbo. Joe says, I don't invest in limbo anymore. It's an underperformer.
Brian says, somebody stole my limbo pole from my garage. How low can you go?
We're on fire here as we talk about this very serious topic. Let's do talk seriously though about investors, because on Facebook groups online, I have seen many people complaining about the fact that some of these online banks that normally are known for high yield, like Marcus or Ally, that they've been cutting their rates, Paula, and people are losing their mind because Ally's cutting their rate. Ally's not really cutting their rate. Interest rates are going down, and good luck finding a better spot. Like, getting angry about interest rates going down with some of these high yield money markets is pretty ridiculous.
Right, exactly. The thing is, and to anyone who's mad when a bank like Ally or Radius Bank or any of the ones that have had reputations for paying decent, the reality is those banks are still paying decently relative to a lot of the other banks. Like the rates that you will find at an Ally or a Radius Bank, or what was the one that you named, Joe? Marcus?
Yeah, Marcus Goldman Sachs's
Mm.
product. Yeah.
Yeah, so I'm not familiar with that one, but the rates that you will find at these places that have reputations for paying good rates are still relative to what you would find at a Wells Fargo or at a Bank of America or at uh, you know Chase. They're still great. It's
Yeah.
just that everything is down. So relatively great, yes. Absolutely great, no.
Okay, so then here's the next question. So if I'm looking for rates and none of these traditional places have it, and you and I are saying you probably can't get it using these traditional instruments, where do you go if you want to bump up your interest rates on your cash?
I mean, you could go into Treasury inflation protected securities, and you can sort of build a tips ladder if you have the ability to do that. Like if you don't need that money immediately, and you have enough money that you could build some type of a ladder. I would say a CD ladder, but those aren't paying very
Yeah.
well either.
No.
So yeah, tips ladder, or as you mentioned on the Afford Anything podcast, Joe, Ginny Mays. You like that plug? You like that plug?
Well, I do. That was very nice. It was a plug for you and me. A, I said something brilliant, and B, it was on your podcast. So both of those together. But what's funny, and we talked about this also on the Afford Anything podcast, is how this is a horrible time to invest in a Ginnie Mae, but especially if you need the money in less than 3 or 4 years, because there still is a chance that could go down. And there's part of me that thinks, and I know you agree with this, Paula, there's part of me that thinks that this is not where you play the game. Like I see people spend all day playing the game, trying to pick up nickels by getting a 0.25% more. You don't play the game here. Let your cash reserve earn 0 and play the real game about making serious money in other places.
Right. Exactly. Because for the majority of people, if you look at what you could earn by doing some freelance work on the side, or doing a little consulting work on the side, or starting some type of a side hustle, you'll be making a lot more than what you could eke out of cash or cash equivalents or very low volatility assets. And even if you're not going to go the side hustle route, even if you are going to focus on your investments, focusing on reallocating the portion of your investments that are in equities, making sure that your asset allocation is aligned with your risk tolerance, your goals, your timeline, making sure that both your risk tolerance and your risk capacity are reflected in the construction of the equities that you hold. That's probably a better use of your time.
Yeah. On that note, an idea here from Tim. Tim said, I've just been slowly moving savings CD money into Series I savings bonds. So there is one to bump it up a little bit. Joe talking about how I can remember my grandmother being mad when somebody paid off the home she'd sold them with a 6.5% rate. She was making bank. Isn't that crazy? I do remember when interest rates were, at the turn of the century were around 5, and thinking that was not very high, and everybody trying to turn 5 into 5.5 or 6. Brian asked if you have to be accredited for tips. You do not, Paula, have to be accredited investor to buy Treasury inflation protected securities.
Mm-hmm. And you can just go to treasurydirect.gov, I believe is the website.
I think you're correct.
I think so.
Nice job. If only we had a device where we could look that up.
I know. I will send them a letter in the snail mail to confirm.
I think we'll let
and we'll get back to you in 6 to 8 weeks.
We'll let everybody else look that up for us. Hey, in just a second, Paul and I are going to have our takeaway from today's piece about money markets and cash. But first, I want to say a big thanks to everybody who used our link when they went to AcreTrader. Farming is difficult, but there's a lot less farmland all the time. And the key with farmland is that every year, as long as the farmer stays in business, if you own the land, you're going to get a rent check all the time. Obviously, as there's less and less farmland, that rent goes steadily up over time. And you get that rent check, by the way, before the crops even go in the ground every year. So you don't have to worry about whether it was a good year for corn or soybeans. You just invest in the land. So what happens is AcreTrader works with the farmer, works with soil sustainability, easy for me to say, works in that field. And by the way, they're in America's breadbasket. They're in Fayetteville, Arkansas, with fields all over the place. You buy a piece of the field, they take care of the administration. Realize, though, there's some significant downsides to farming and buying farmland, the most of which is if you need cash, we're talking about cash today, if you need cash right away, you can't go just peel off a few rows of your farm to cash in to get something. Much like if you had a house, you couldn't sell the bathroom to get money. So this is an illiquid investment while you own a piece of that land. But when you look at the returns over time in farmland, it can be very attractive. This is, by the way, to Brian's question earlier, only for accredited investors. To find out what an accredited investor is, do you match that to watch the explainer video and to start to educate yourself? Head to acretrader.com/MWF to find out more. And that's MWF sends you from us so they know that we sent you. And that's, by the way, how they pay us. They give us a thank you for sending you their way if you decide that it's for you. All right, guys. Paula, what's our takeaway here?
I would say the takeaway is that anytime you're holding money in cash or low volatility assets, something that feels like it's the equivalent of cash, such as a money market fund, or laddered CDs or laddered tips, you're not, especially right now, not going to get a whole bunch of return from that. So minimize the time, energy, and attention that you spend there. Minimize the risks. For example, money market accounts are not FDIC insured. So know and minimize risks in those regards. And then turn your attention to the big stuff. Making more money, getting a promotion, starting a side hustle, making sure that your equities are invested properly. Turn your attention to the stuff that's going to give you dollars instead of pennies.
Yeah, and I totally agree with all that. And I'm just going to say, for the people that really worry out there about this stuff, about their cash and making sure that their cash doesn't lose money, that's when you want to look at FDIC insurance. Make sure that it's FDIC insured. By the way, SPIC insurance, which very hilariously, if you remember, Paula, Robinhood said that, hey, this is SPIC insured, so nothing can go wrong. SPIC insurance is a whole different thing, guys. SPIC insurance is actually insurance that your broker won't run off with your money. It's a whole different type of insurance. But if you want to make sure that your money can't lose money, make sure it's FDIC insured, or inside of a credit union account, it's NCUA insured. So NCUA, FDIC insured. So I like yours better, Paula, but I want to add that for all of our warriors.
That's excellent. Lots of acronyms.
Something else that's excellent, I heard, is the AffordAnything podcast.
You know what else is excellent is that segue.
Well, thank you very much. How do I get me some AffordAnything podcast?
You can find the AffordAnything podcast on your favorite podcast playing app. So go to Apple Podcasts or Pandora or Spotify or Overcast. Go to wherever you like to listen to podcasts and search for AffordAnything. And when you're there, hit the subscribe button or the follow button. And know that there's a guy by the name of Joe Saul-Sehy who says some brilliant stuff on the podcast, including a discussion that we had on the most recent episode about Ginny Mays.
I like all the people here talking about how Joe and brilliant don't go together. Like that's not great. Yeah, Brian, at least we learned something from Paula. Thanks there. Well, that's why we have Paula on here as well. So your AffordAnything available wherever finer podcasts are. Once you get done with this, go over there, hear us on AffordAnything, and a bunch of great guests too. She has, it's funny because Paula's show, by the way, when we have the same guest on, we'll talk to them for 20 minutes. Paula will talk to them for about 7 hours. No, I'm kidding. You'll talk to them for about an hour. But when you talk to them, we ask completely different questions. So it's a good, even if you've heard the guest before on my Stacking Benjamin show, listen to them also on AffordAnything and you'll get a more complete picture of that guest. All right. That's going to do it for today. She's Paula. I'm Joe. We'll see you back here next time at Money with Friends. Bye-bye. 19.
Nice.
Bam. We did it, guys. Good work. These are.
Jim, thank you. One of my favorite financial personalities is Paula Pant. Guy on the left is okay.
Yeah, thank you too for the rest of that, Jim. I appreciate it. Oh my God. I'm just going back. Yes, we're name dropping each other. How great is that?
I know, right?
Got mad skills.
I don't like to brag, but I know Joe Saul-Sehy.
And I stayed at a Holiday Inn once. All right, Paul and I are going to take a break. We got a half-hour break before we got to meet again for Stacking Benjamins, so we're going to let her go and stretch out because she is. We're doing one of our famous. See if you can hear this. Can you hear that? We're doing one of our famous game show episodes, and I love those. And I know that Len, Paula, and OG hate them, but this one is going to be really fun. And Paula knows I've been talking about it for like a month.
Yes. So I've heard him talk about it, but I have no idea what's actually in store. Like, I don't know what we'll be doing. I just know that Joe's excited about it. Yes. Which is a dangerous combination. Dangerous.
Paula's like, oh, crap. No. Oh, crap. All right, guys. We'll see you next time. Bye-bye.